Do you struggle with investing? Many people feel lost when building a portfolio. Some take too much risk, while others keep their money idle. The key is balance, maximizing growth while protecting your capital. Let's break it down step by step. The first step is knowing your investor profile. Are you risk-averse, moderate, or aggressive? If a sudden market drop makes you panic, you're likely conservative. If you see it as a buying opportunity, you have a higher risk tolerance. Your profile shapes your investment choices. Next, consider your investment horizon. Are you investing for the short term or long term? The longer your horizon, the more risk you can afford. Young investors can focus on stocks for growth, while those nearing retirement should prioritize stability. Diversification is the foundation of a balanced portfolio. Investing in a single asset is like walking a tightrope without a net. A well-balanced portfolio spreads investments across different asset classes, reducing risk and enhancing long-term stability. A strong portfolio includes stocks, bonds, real estate, and international assets. Stocks offer high returns but come with volatility. Bonds provide stability and predictable income. Real estate generates passive income and appreciates over time. International assets hedge against local downturns. Let's refine diversification further. Within stocks, invest in different industries like tech, healthcare, and finance. In bonds, mix government and corporate bonds with various maturities. In real estate, consider rental properties, REITs, or funds. This approach minimizes sector-specific risks. Asset allocation is key. A conservative investor might allocate 70% to bonds, 20% to real estate, and 10% to stocks. A moderate investor could choose 50% stocks, 30% bonds, and 20% real estate. An aggressive investor may go for 70% stocks, 20% international assets, and 10% bonds. Rebalancing is crucial. Market movements can shift your allocations over time. Reviewing your portfolio regularly ensures it stays aligned with your risk tolerance and goals. Adjustments help you maintain stability while optimizing returns. Emotional investing is a major pitfall. Many investors make impulsive decisions based on fear or hype. Avoid chasing trends or panic selling during downturns. A well-thought-out strategy will keep your investments on track even in volatile markets. Fees can erode your returns over time. Pay attention to management fees, brokerage commissions, and transaction costs. The lower your expenses, the more your investments can grow. Always compare options to find the best cost-effective strategies. Patience and consistency are essential. The most successful investors don't try to time the market. They invest regularly, take advantage of compounding, and think long-term. Sticking to your plan is the best way to build lasting wealth. Now it's time to apply these principles. Define your investor profile, diversify wisely, and stay disciplined. Avoid common mistakes and focus on long-term growth. If you found this helpful, like and subscribe for more investing tips. See you in the next video.